Hey folks, welcome to Pro Trader Strategies. I got so excited to get this thing started because I want to talk about what's going on in the markets today that I got a little bit ahead of myself. I'm not even quite ready yet. I'm not supposed to go on for a little while, but life is happening. And I know you folks are probably just as anxious to talk about the markets as I am, especially with everything that's been going on as of recently. So without further ado, let's get on with this. I'm going to be talking about our options guide here. And this is really breaking down the options and cracking the code to trading options. By the end of this, I think that you folks are going to walk away from this and just be like, man, that just makes all the sense in the world. It's not as hard as everybody makes it sound. We can make all of this make sense with building from simple concepts to real life examples. And by the end of this, those real life examples are going to be pretty intuitive. As a matter of fact, you'll be answering questions probably before I even answer or ask them from you. But hey guys, like I said, I came in unannounced on this. It's scheduled for a little bit later. Life happens. So please subscribe and make sure you hit that bell. The bell is what tells you when I'm coming in unannounced. Also, please hit that like button for me. It feeds the bots to run out there and share this content with folks that look like you, or at least the bot thinks like you. All right, so this is our options guide, cracking the code to trading options here. And we are going to be talking about, let me figure out what I got going on here. I got too many screens open here. We're going to be talking about the short put spread. Now, I'm not going to jump in full tilt head first before testing the waters. I'm going to let you guys know. I'm going to build, like I said, from simple concepts to real life examples. And by the end of it, we will then talk about the short put spread. And by that point, I think you're going to understand why we're doing this video. So let's make this simple. This is data. And when data is streaming, it kind of looks like that option montage page. But what we really want to do is snapshot this, freeze frame what's going on in that page, peel back the layers of this onion to find out what is really driving the pricing over there. So when we start with simple concepts, like this is data transfer. It's just all the way down to O's and ones. It's the most streamlined way to transfer data, at least at this point. But when we peel it back, you know, when it's streaming really fast, you can't really tell what's happening. Freeze frame it, you can tell it's simply O's and ones transferring data in different streams, if you will. You can see the different layers through this. So with that said, when we're going through all of this, the transfer of data, what I want you guys to come away with is really pricing, okay? That's ultimately what we are talking about when we're trading options, is the pricing that's going on in there. Now, don't run away just yet. I'm going to make this simple as we go along here. But anybody out there watched housing prices lately? What's been going on? They've been flying, right? Getting higher and higher if you think about this as being the pricing mechanism of the housing market. As a matter of fact, it's still continued to rise. Well, that's what's always expected. As a matter of fact, if you go out there and talk to investment professionals, probably 7 out of 10 would probably say that the best investment you can make is in a house. Why? Because it always goes up. Buy low, sell high, so easy. Well, what's going on right now that we're seeing? As a matter of fact, the market has been having these conniption fits because the Fed really doesn't know what's going on right now. As a matter of fact, Powell may have backed himself into the corner by talking about doing a 75 basis point move at the next meeting, or that it wasn't at least off the table. It was a possibility. And then he went on to say further that he doesn't even know if the Fed can actually accommodate a soft landing, which means really he's pretty darn concerned if he doesn't have any idea really. But when interest rates go up, we do actually see housing prices start to dip. And as a matter of fact, even if you go back 5-10 years, right, through the financial crisis, through the pandemic, both of those times going into the financial crisis, we saw housing prices at all-time highs. Then during the financial crisis, they cratered. We've shot back, coming back into the pandemic, we took a little dip there, and now we've continued to shoot higher, right? Well, now are we going to start dipping down as interest rates go higher? If you think about you and I, we all have a budget, right? We have a finite amount of money that comes in every month or every year, and usually we need to budget that. Most folks will say about 20, 25% of your income goes to your mortgage, your rent, or something like that. Well, when interest rates go up, then the price of the house has to come down. Why? Because we all have our budgets. And if we can only afford enough or a certain amount a month, well, that will have a tendency to draw prices back down a little bit. So one would expect that as folks are paying more to the interest rate, less to the principal, it's still the same amount. They're going to be able to only buy a smaller house. Plus, as interest rates go up, it makes it much more difficult for folks to get a loan there. And Powell going on with the soft landing, not so soft maybe. Well, that really is going to raise questions with a lot of folks as to whether or not they really know what they're doing or if they're just kind of shooting from the hip. But what I want to get to here is if you bought a house recently, you've done very well. If you've watched housing prices over the last 10 years, despite the fact that most folks will say that a house is one of the best investments, it's not always the best time to be buying a house. So when we're to go further, trying to figure out whether you buy a house or sell a house, most folks will come out there and tell you all you have to do is buy things low and then sell them high. Now, while that's a really simple concept, right? Everybody knows you want to buy low and then sell it high. That's how you make money. The problem here is what does that mean? What is low? Is a house that's $100,000 low right now? I don't know. It's hard to compare that to anything else because I don't even know what that house looks like for one, right? So when we're trying to determine whether the price of this is $25 or $100, it really kind of depends on a couple of things, whether or not you need this pen or whether or not you're willing to pay the price for it. So demand will drive those prices higher. So when folks are saying buy low, sell high, it seems like such a novel idea. But what we find ourselves getting caught up in when we're trading is the problematic buying. What is the timing on that, right? Now, there's a lot of you folks out there that are probably better chartists than me and probably could do better lines or figure out support and resistances. But let's just say, for instance, this is the first time you saw the market open and you see it shoot higher. Well, you missed that opening trade. Not everybody thinks they can buy the low, but you wait for that pullback. And that's where you think, all right, you know what? I'm going to buy low. And look at this. It shoots higher. What happens? You're a brilliant genius, right? You came up with the light bulb now. It's a light bulb moment. I'm a genius. And then it pulls back to where you were, right? Now you're a little bit concerned. It's pulled back. Anytime we've seen that massive move higher and a pull back to our level, we get a little bit panicky. Well, the market moves higher, so you're thinking you're off the hook here. We're all good. And then the market slams back down to that one area where you wished you would have bought it. Now, at this point, we don't know anything going forward, right? We don't know any of this. So could it continue down lower? Yeah, that's what your concern is going to be, is if it goes below, especially like an IPO level, starts going below that, we could see a real panic at the disco. So at this point, we don't really know. So we could just sell because we don't know if it's going to go lower. So buy low, sell lower, not really what we want, but it could have been a buy low, sell low, but not the slowest, right? So we can stay away from that. So selling isn't always at that level we want, pop up, maybe it runs back up here. You buy it again. You keep getting caught in that vicious cycle going back and forth. That's going to be painful. So when we're talking about buying low, selling high, that really doesn't correlate really to trading, because buying low is very vague. But one thing that we can rely on is the fact that the options pricing, well, they tell us whether or not they're cheap or expensive, right? When I'm talking about XYZ stock, if I'm saying GM is trading around, let's say 30, is that expensive or cheap? Well, based on forward multiple, blah, 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 you're going to hear some folks will say it's cheap. Some folks will say it's expensive. We don't know. It's just a price at this point. But the thing with the pricing in the options is we know when options are cheap or expensive. Now, I'm not talking about, like shorter durations options are obviously cheaper than longer duration options, because those longer duration options, you have to pay for the opportunity to be involved longer. So you're paying for time. All right. So that's why longer duration options are more expensive. You're buying more time to be involved in this underlying. Okay. So that is a simple concept. Closer to expiration, there's not much time. So you don't have to pay very much. But if you want a long time to see your strategy work out or your assumption to come to fruition, then you need to go further out in time and you have to pay a little bit more for that. That's not what I'm talking about here. What I'm saying is we can tell, given apples to apples, if XYZ's options are cheap or expensive. Why? Because volatility looks like that chart we talked about, where you can literally, it's a little bit easier for folks to see sideways or neutral trending markets, a lot easier than it is to discern a bullish trend or a bearish trend and those support and resistances. Our eyes are just more accustomed to seeing that. It takes more of a taught eye, I guess, if you will, to be able to see some of the other types of trends. But if we draw a line in here, try and get our support and resistances, right? That's what most folks will do with trading around a chart, is they'll find where the underlying comes up and bumps its head or falls off and catches some support. That's where you want to start getting involved in trading, right? If you've seen a bullish market, you've seen people try to put some lines on there, right, to figure out where you should be buying or selling, right? That's what you do in regular markets. Even if it's going down, you're going to be looking for different channels for that bearish move. Okay. So that might be where you're finding those support and resistances. Like I said, it takes a little bit more of a trained eye for that. But, sideways markets, our eyes can pretty easily kind of put that all into a nice little channel relatively easily. So at that levels, you can see when the underlying is trading, because volatility has a finite range for that underlying, meaning XYZ stock. If we're talking about a stock and it's XYZ, well, its implied volatility is going to look like this. Even Tesla's implied volatility is going to look similar to this, all right, where we see these sideways trending volatility coefficients. And that tells us if prices are expensive or cheap. How do we know that? Because volatility, there's a couple of givens with volatility and all of the options, actually. The options all make, or the option montage, all those Greeks, their assumption is an advancement, all right? Meaning the underlying moves higher by $1 or one day goes by. Well, when we're talking about volatility over here, really what we're talking about is 1 percentage point moves. Okay, meaning this number over here moves up or down, which is just implied volatility, moves up or down by 1 percentage point. Okay, and the assumption is higher by 1 percentage point, meaning if this moved higher, and that is 1% higher, going to 31 now, 08. So it moved higher by 1 percentage point. That means that all of the options over in the option montage correlated to ABC are moving higher. All right. Now, if we saw this start to come down and say now it's trading around 28, it's lost 3 percentage points. What does that mean? It means the options are getting cheaper over there. Now, do I know how much right off the top of my head? No, I don't. I have to go over there and look and check it out. But at the end of the day, we can look at this and see that when we have sideways trending markets and we can draw in some support and resistances, we can tell when this volatility for ABC is at an extreme. All right. And when it gets to those extremes, that's where we want to take action. It's not whether I'm bullish or bearish. It has nothing to do with that at this point. Really, what it has to do with is once I come up with my directional assumption, whether I think ABC is going to go higher or lower, then that is where this starts coming into play. All right. I come up with my directional assumption. The next thing I need to look at before I even decide what I'm going to do is look at where implied volatility is. Because if I have a bullish directional assumption and I've got volatility going down, right, then, you know, there's going to be things that I'm going to have to take into account there. If volatility is coming down from an extreme level, do I want to be buying options? Right? I mean, probably not if volatility is coming down, although the pricing is getting cheaper. I haven't even talked about what the price of the underlying is done if it was trading at 100 to begin with. And now what is it trading? I don't care right now. All I'm trying to determine is if I'm going to be a buyer of options or a seller of options, right? Because if volatility is extremely low levels, that means that those options are extremely cheap over in the option montage, which then means I need to be buying, right? We got to buy low, sell high, or sell high, buy low, okay? So when volatility is at extreme low levels, we want to be buying. And when it gets up to an extreme high level, that's where we think we need to be selling. So going back to this, a lot of times this is a 3-year chart of a volatility of an underlying. And you can see that you can go back several years and see that this underlying has its own volatility coefficient, meaning once it gets up to this one, especially it gets up into the 40, let's say it gets up around 41, 42, you can see it starts losing that momentum, right? We can say this is 42, let's call it. Gets down here at around 23. That's where we're starting to see those support levels, right? Where it does pierce through on a couple of occasions on the top and the bottom side. But at the end of the day, you can see that as soon as it does pierce, it does have a tendency to start losing some of that momentum. Yes, we have the pandemic. I'm not taking that into account, other than I wouldn't mind leaving a line in the sand up there so that the next black swan event, that's still stuck in our head. We don't have to go searching for that. So I might throw that in on a chart as well. And another thing I want you to look at here is the idea of coming up with like a 50-50 line, right? When you come up with your extreme levels or your levels you're comfortable with, come up with that 50-50 line, right? Meaning half the time it's above it, half the time it's below it. Why? Because this is your sell zone and this is your buy zone. If you have a lower risk tolerant trading habits, then go maybe 3 lines there. And now you've got the 25% line on both sides, and you would do the buys. Now you're going to have less opportunities when you do it this way, but you're going to be catching it at extreme levels and not take as much pain as some other folks that get involved sometimes a little early. But I have a high risk tolerance, so I'm more than willing to take a little heat sometimes there. So again, if we were trading this as XYZ, I don't know, started flipping through a bunch of charts. XYZ, you know, this would be, no matter what our directional assumption would be, we would be thinking it's probably more appropriate to sell options, collect a credit. It doesn't have to be naked options. It could be a spread, but you have to think with this type of level, I need to take advantage of the pricing and take some money and stick it in my pocket, right? And then on the flip side, if we started seeing something that was below that 50-50 line, you know, this would be an opportunity to what? We can draw in our lines right here. I got an extreme high level and extreme low level. And yeah, it does break through a little bit there. I'm not too concerned about that. I flip in my 50-50 line. I could even throw in my like 25 lines, somewhere close to that. And you could see that it is in a buy zone. You even got the kicker where this is starting to move higher. So that gives you another little vote of confidence, if you will, that buying the option at this level, based on your directional assumption, whether it's bullish or bearish, you would be wanting to pay a debit. Not because you just want to throw money out the door. No, it's because you know you're buying it cheap, right? This tells me that over the last 52 weeks, we have barely been down there but a couple of times, not even every single month, right? So therefore, we've gotten an opportunity. we got to turn the tables into our favor, right? Because when we're trading, guys, we can try and do everything we can to get that table turned in our favor. We do charting, we do support and resistances, right? We're watching the news, we're digging into the internals of this stock, maybe even getting down to the minutia. All right, a lot of folks will do that, but you still can't really tell whether the stock is cheap. But with this, what we can do is look back knowing that implied volatility, which is off this chart right now, but implied volatility, which is just Vega, implied volatility gives you the indication whether or not prices are expensive or cheap. So I use this as implied volatility. Somebody's asking that, hey, could we use historical volatility rather than implied volatility? I guess the platform doesn't have it. So yes, you can use historical volatility. Implied volatility, I think, is superior because implied volatility doesn't even care about what's happened in the past. It's forward looking and just trying to determine what's happening going forward. And it doesn't skew the data as much as sometimes historical volatility will skew it a little bit. But you can still tell when it's at extreme levels. Now here, another one where it's breaking through. So for me, I'm probably going to get involved a little bit earlier than some of you folks. And I am looking at this as being in a sell zone. So if I am looking at Apple, for instance, in this regard, implied volatility, I can see that Apple has a nice support and resistance area. I can kind of draw in my 50-50 line, real dirty, but I can see that it's in a sell zone. Can it go up to this level and still increase another 5 percentage points or so to get up to 50, let's call it 53 or something? Yes, it could continue to ratchet up. But we can see that most times when it gets up into these levels, we get that volatility crush, all right? Now, the last thing you want to be doing is buying options at these levels and then get one of these drops, right? Let's just do a real quick dirty math. I'm not going to get down to the minutia on it, folks, but I will try and get down on some math here. So let's just say, for instance, on this one, we go from this level, which we're going to call it somewhere around, I'm going to call this, say, let's just say it's 46, right? So we've gone from 46 all the way down to here. Let's just call it 30 because that makes math easy. It might be a little bit lower than that. So actually, let's call it 36. No, it wouldn't be 36. Anyway, call it 30. So it drops 16 percentage points, right? That's 16 down to 30. So it dropped 16 percentage points in a matter of days, right? And that's not unheard of right there. We can see that it dropped, you know, probably 15 ticks or so, maybe 12 ticks or something. This one was a bit more extreme, 55 all the way down to past 35, so 20 percentage points. So while I'm saying this, we see a drop like that. What happens over in the option montage, even if this is Apple, right? This is Apple. If Apple goes and $0 change, it's still flat over the next couple of days. And we saw this free fall. Our options prices are going to get cheap, even if Apple is just doing this trading sideways. Okay. And our volatility will come out. Those prices will crater. And I'll show you how much it will drop based on, you know, some of those past indicators. So volatility, if you haven't gotten it so far, is driving price. Now, here's my example that I wanted to use as a real life example. I think we're pretty close to peeling this in, but the reason why is because we're at some extreme levels. And I know folks out there love Apple. I think it's about time to start turning our hands around. You know, that's what they say on the floor is, you know, turn those hands around. If you've been in a bearish market, we've been selling, turn those hands around. I think we're about at that point where we're going to be turning them around. It's not confirmed yet. Tomorrow, I think we could probably get a positive day, but I would not jump on board with going into a weekend like that. But I do think we're very close to a bottom here. I think at these levels, Apple would be an opportune place to be buying it. As a matter of fact, I would probably even like to buy it somewhere right around this Fibonacci, but with the volatility as extreme as it is and where the underlying is trading, I can sell puts somewhere down around this area, probably a put spread, and lock in my strategy. So if it goes below the Fibonacci here, I don't have to worry about anything, but I could also then have the opportunity to get long this underlying. If we start getting a reversal, even if this underlying were to kind of start to trickle down, what we can see is that this underlying could start trickling down and sell down to this level, go sideways or whatever, and even maybe break down as long as it's going sideways. And the volatility starts coming out, we could be directionally incorrect, because I got a bullish sentiment with Apple right now. I feel this is an opportune time. It's going to bounce off this Fibonacci and start rallying. So I've got a bullish assumption. Next thing I do, look down here, extreme levels. What's happened after those extreme levels in the past? Well, we get that volatility coming out on a crush. So I get massive volatility coming out. That will help me with the strategy. So before we get on, I want to talk about something really quickly, and don't run away, folks. This is where the light bulb movement's going to happen, I hope. But we have the Greeks. All right, don't run away. All right, Delta. All right, Delta is the rate of change. The rate of change in an option. That's the symbol for Delta. It's not a very good one, but anyway, let's try and color it in so it's a big Delta. All right, so Delta is the rate of change, meaning for when the underlying moves higher or lower, our option strategies are going to fluctuate. Now, you might be like, oh my God, you just got done telling me. This is based on how the underlying moves. Remember, we said all options are based on a positive move, all right? An incremental move higher, or an advancement, if you will. So this is based on $1, an increase of $1, all right? So the first dollar move. And when we're talking about trading, especially over in the options that are at the money, meaning we were looking at an example of ABC. Let's just say ABC is trading $100. Those options that are right at the money, meaning they are the options that are trading as close to the underlying as possible, being if ABC is trading 100, what do you think the closest strike to ABC is? Well, it's the 100 strike. The 100 calls and the 100 puts, those strikes are going to be about a 50 delta, right? Calls are going to be positive, puts are going to be negative. And we'll talk about that a little bit more in detail in a minute. So what this is saying is the at the monies, whatever that, which is the 100 delta or the 100 strike, the 100 calls at the money have a 50 delta. Why? Well, because the probabilities of being successful on any stock trade is 50-50, meaning you have a 50-50 chance of picking the opportune time to buy that underlying. It could move higher or it could move lower, and your probabilities are 50-50 from the time you set up that trade. So it makes sense that the deltas at the money are 50. Why? Because delta not only tells us how much our prices are going to change based on the underlying moving higher or lower, delta tells us the probability of being in the money by 1 penny at expiration. All right. Meaning on the very last day, you have delta telling you your probabilities of being in the money. All right. So 35 days out, I look at the at the money strike. It's going to give me a 50 delta. It means, am I going to be right? It's 50-50. All right. But if the underlying moves higher by $1 and we're at the monies, these are probably like, $2.50, let's say $2.60 or something. Well, if it moves higher by $1, now we move higher and we're at 101. Well, now my premiums increase by the delta. So we would be looking at $3 and $3.10, right? On that first dollar move higher. Pretty simple. And you probably all have heard that. What you may not have heard, though, is 2 times the delta equals your probability of touch. All right. So while delta tells us the probability of being in the money by 1 penny at expiration, it also, the floor trader hack, what we used to use on the floor to, get our minds right, is 2 times the delta is the probability of the underlying coming up and touching you or coming down and hitting your strike during that life. Meaning you see it trade that price and maybe then it falls away. All right. So the probability of touch means during the life, however long this stock option is available, it has 2 times the probability of seeing that strike trade. Okay. So 50 delta, 100% probability. Probably because you'll see it uptick and trade that price, or the fact that it's trading that price right now. All right. And then the other one most people don't talk about, except for shorter term traders, is gamma. Right. Now, gamma, the easiest way to remember that, it's usually like a really small number, is gamma goes with delta. All right. So gamma, well, it's an increment. This is on the number $2, right? We saw what happened on dollar number 1. This was dollar number 1, right? This is 1. Now gamma goes with delta on number 2, right? So gamma goes with delta, and now we would see our prices being $3. 5 plus 55 is $3.55 at $3.65 if XYZ is now trading 102. Okay. I know I'm writing all in a little tiny square, but all right. So gamma goes with delta. And then we've got the thief. Right. That's not a Greek. The thief is just theta. All right. Theta is the thief in the night that comes and steals your premium. Every single night he comes and steals your premium. Right. And it's not linear or binary or any of that. It is a slow roll, if you will, and then it really falls off a cliff. So we'll see it kind of come out and then come off a cliff. So if we look at this, this would be something like 7 days to expiration, 35 days to expiration. And then basically out here is like 70 days to expiration. All right. So with that said, if this is what's happening with Theta, meaning he's coming in and getting really aggressive stealing premiums, do you want to be buying inside of 35 days to expiration if you see this going on? No. You want to be buying out here where this, I mean, it's never flat. It's always slightly increasing, but it's just barely enough to where the eye can even see it. So buy zone is outside of 70 days. And, I pulled this out just a little bit to 45 days to expiration to start setting up. But this is your sell zone, right? Because you want to sell high and buy low. So like when I said I was trying to build from simple concepts to real life examples, I think I see a lot of you guys' light bulb moment going off and starting to think, you know what, that is right. That does start to make sense. Why would I want to be buying here? And yes, folks, it is more expensive. It's a little more pricey out here than it is inside of here, okay? Usually. And the reason why is you are buying time, right? The more days you are wanting to be involved in this underlying, they assume you need to buy it. Well, I look at it like my trades aren't going to last longer than 70 days. They probably usually only last maybe 2 weeks at most. So why am I going way out there in time? Because I'm still a good steward of my capital, you guys. I may have to put up more money, but if I know it's not going to go anywhere due to Theta, then I'm more willing to do that. If I go in here and I have to pay a little bit less, but tomorrow I wake up and instead of having 1 penny gone, I got 25 cents gone. That's a big difference. I'd rather have the penny be gone and locking up $5 rather than a 25 cent getting taken out of my $2 trade. So you don't have to worry about Greeks, but one thing we do want to talk about is, before we do that, is Vega. It's one of the ones I forgot. Before I accidentally hit that button. So Vega is the one that we've been talking about, right? Vega is implied volatility, guys. So that chart that I was talking about over on the side underneath all our stocks, I put that chart down there so I can see. When I'm looking at the charts, I'm flipping through the charts and I'm trying to say, hey, you know what? This is a buy. This is a sell. This is a buy. This is a sell. Meaning I'm bullish and bearish. I'm bullish and bearish. Well, if I go on bullish, then I look straight down to the implied volatility. Well, if I'm bullish and volatility is high, what do I need to do? I need to find an option strategy that I can sell and capitalize from my directional assumption, right? So Vega, while it is based on a percentage point move, Vega moves in like 10% point increments. We saw that with the Apple example, right? So Vega, when it's at extreme levels, we know that all those percentage points have gotten added in there. So we want to take advantage of volatility. When it's high, we sell. We want to take advantage of volatility when it's low, and we buy. Further, something to note with Vega, further duration options get affected more. Get more. All right. So I like to look at it this way. When I'm buying options, the volatility is obviously super low. If volatility is going to affect those further duration options, that volatility spike will increase my premiums even if it doesn't go anywhere. I mean, even during the financial crisis, folks, we saw those massive sell-offs. Calls were gaining in value during the sell-off because volatility was exploding. All right. So you will see that happen. And that's why you need to set yourself up for success. The only thing we can do to really be successful as traders is set up our strategy correctly at the beginning of the trade. And I see so many people out here. And one of the reasons why I started using this Apple example is because I started seeing folks talk about going out there and buying calls in Apple right now. It's at a great level. It's come back down to this level. We should be buying it. Apple is at a, and let's get some calls. Let's buy some calls. So they all go out there and buy calls. Well, what happens when we see one of those volatility crushes happen, right? We saw in a previous chart there. Here, I'll just pull up. This is Tesla, but let me get Apple on here. So like this, when we were talking about, remember we said if we get like a 10 percentage point drop, I've got this on here now. So 33 from 47. So let's just call that, let's call it 15 percentage points just because I want to do math with it. All the crazies. So 15 percentage points, we'll say, comes out. Well, what would happen if 15 percentage points came out right now? The volatility coefficient is always positive on Vega. We can see that. Let me get my pen fired up here. I do not want that. I want this. All right. There it is. Let me get my pen over here. All right. Sorry. Okay, so this example, if we are to look at volatility, and we were talking about this being 1 percentage point, right? Okay, so we get 1 percentage point move up or down. If it moves higher to 49, 16 cents goes into these premiums. But we just saw, let's just make math even easier. Let's say we get a 10 percentage point drop, which is what we would expect. 10 times 16, 18, 18, 16, those at the moneys get a little bit more on these puts. Well, if this increase or came off by 10 percentage points, and we would be now at 38.33, right? Well, we would see 10 times this, so $1.60, $1.80, $1.80, and $1.60 come out of the premiums, right? If it jacked up 10% and it jacked up to, now we're at 58.33, right? Well, then this would have been a positive, increasing on all of the options. You could go over to here. All of these options would increase across the board if we saw volatility increase. Vega explodes. We see the pricing explode in tandem. Okay. So, Let's just get rid of all of it. So let's go through this again. I'm just going to go through the steps in the option montage so we got this going, right? Everything's an increase of 1. So we go to 142.37. So increase of $1. We've got delta going into the pricing. So we would see 57 cents go in here and we'd be trading $5.62, something like that. And on the flip side, it would be offered at 5.67, right? Then if it goes up again, and now we go to 43.37. Now gamma goes with delta, and now that gets to 61. 61 then goes into those premiums. We were at 162. We had 61 in there. Now we're at 623 or something. I'm just throwing close math out there. So another incremental higher, right? And then if we look over here at the theta, we notice theta on both the calls and the puts are negative. Why? It's an incremental move forward. So we can't go back in time. So we know tomorrow we wake up and the thief in the night has come and picked our pockets a little bit. But when I was talking about further out in time, remember I drew that nice little linear or nonlinear curve there. We talked about how theta here is less aggressive. Look what happens. We're out here at 90 days. That's outside of that 70 days expiration I was talking about. And you come in 35 days, right? What happened to theta? Not much of an increase. It went from basically 6 cents to 7 cents, maybe increased by 2 pennies, right? Now, what happens when we go in from 64 days and come in less than 30 days? Well, if even less than 30 days, this is almost doubled. Not quite, but it's definitely more than 2 or 3 pennies. It's basically like 4 or 5 pennies at that point. And then you come in the next 30 days, and what happens? We go from basically losing 11 cents a night to inside of 7 days to expiration. It's gone all the way up to 28 cents a night. So that's easily doubled. All right. Even more so. So when I'm talking about folks that are buying options here, they're going to get beat up by theta. So don't buy options inside of 35 days to expiration, you guys. It's just going to be painful. You have to be immediately right in order to be profitable. If you don't, theta is going to counteract that. I mean, look, 26 cents a night in theta here. And look, if it moves higher by $1, you only gain 41 cents. So that's why I'm saying you got to have those big moves happen quickly if you're buying options inside of here. And it's even exacerbated more if you are buying options and you have really high volatility, right? What if this volatility starts going down while the underlying's not doing anything? You have the volatility coming out. You got theta coming out. Like literally between the two of them, if you went down 1% every day, it would be really painful. I mean, those two added together almost equals your delta to counteract that, all right? So when I'm talking about the levers and pulleys in the markets, we want to line all of these up so they are in our back pocket, right? Delta we can't do a whole lot about other than know what the probabilities are, and that will help us determine our levels, right? The other thing is theta. We can take advantage of theta by selling and letting theta pick away at it. So we want to sell at the nearer durations and buy further out so we can be a good steward of our capital. And then Vega. Vega is a determining factor. We know when volatility for Apple is at these extreme levels that it is going to want to come back down. So I'm looking for volatility to come out of Apple, and I'm bullish, all right? So I want to be selling some type of strategy, probably puts, right? Because puts are directionally bullish for a trade. I would not want to be selling calls. Although I don't think it's extremely risky, it just doesn't fit my directional assumption. I don't think that we'll probably even rally up high enough to hit those short calls. So, if you're bearish Apple, then don't be going out there and following my trade because I'm bullish Apple and I want to sell puts. If you're bearish Apple, you could probably be wanting to sell an option strategy. All right. So we can see that Delta, again, positive over here. Delta on this side is negative. Delta is negative on the puts because the assumption is a move higher, folks. Every increment higher, these are less likely to be in the money. So you can see that Delta affects the nearest duration options at about 50-50. In the monies, definitely a higher Delta because a higher probability of being in the in the money by 1 penny, right? But Delta is negative over here because it's an incremental move higher. Now, if the underlying started going down and it goes down to 140.37 or moves down by $1, right? It's a negative dollar plus a negative delta. Negative delta equals positive deltas to your position. All right. So if I sell this contract, then if I sell it or it goes down, then it becomes a positive to my position. Right. And you can see theta is negative on both sides because you cannot stop time. Vega, much bigger, further out in time. You can see it starts dwindling. Why is Vega getting smaller the closer and closer I get to expiration? Does anybody know? It's because it's, everything becomes a little bit more clear, right? Like Powell talking about the next meeting. That's not for another probably 6 weeks. He's talking about 50 to 75. Well, none of us can really see that far out, right? We know maybe what's going to happen in the next week or so. We can't really tell especially in this day and age, what's going to happen in 6 months from now. I mean, we've got all kinds of crazy things going on in the world. So 6 months from now, very vague. Well, if it's vague, there's volatility because there's fear, right? Vega is fear, all right? So further out in time, we don't know. So there's that premium that we have to place on that unknown, if you will. All right. So last week we talked about the options, right? We were talking about selling puts, and I talked about specific strikes, right? We were talking last week around that 16 delta option. In this case, we would be looking at the 122.5 option. That's the closest to the 16 option we have. So that's where we were looking to sell options yesterday, right? Now today, we've got a bit of a different setup here. Volatility did increase a little bit, I think. Why is CL on here all of a sudden? Did it? I know I saved this. Oh, I know what I was doing. CL was our example for this selling puts last week at around that 16 delta. This trade has actually done pretty good despite the fact that we've not necessarily gotten the directionality right, but the volatility's come out. Theta's really helped because we're inside that sweet spot. I think it's down about 20 cents from here. But when we're selling an option naked, the reason why I go further out in time or further out in the option montage to that 16 delta is because of those probabilities. Remember, 2 times the probability of touch. Well, I only have a 32% probability of that and a 16% probability of being in the money. In this case, we're looking at a different delta, but this one's 19 delta. So it means a 19% probability of being 1 penny in the money, or basically a 40% probability of touch, meaning the underlying goes down there and trades 70 and bounces away. So a little bit further out, getting about 85 cents for this trade. With the put spread, to really get this to work out properly, we need to why is this? Sorry, folks. I'm trying to figure out why my screen looks like it's kind of frozen here. I don't know if you guys can see what I'm seeing. It looks like it's frozen. There we go. Looks like it's back. Are we back? All right. For some reason, something was happening there. All right. There we go. I don't know what happened. Sorry, folks. So now we have to be a little bit more aggressive because of the defined risk aspect of this trade. If I pick the 16 delta and I define that risk, or that 19 or whatever, folks, what happens here is that I end up risking way more than I'm going to make. Like my rule for creating a strategy like this, a put spread or a call spread, short put spread, short call spread, is that you're going to collect about 25, on best case scenario, 30% the width of the spread. So in this case, I've got a $10 spread, right? I'm risking $2.50, or I'm trying to make $2.50. That's a quarter of the entire spread. So you're trying to make one and risk 3 in this case, or make one and risk 2 on the 33%, which is the best case scenario. Couldn't build that out with this one, but I love the levels. Trading around that 35 level, getting long there. We saw there's a support at 40. We went down there, kind of tested that area. So I'd be looking at selling the June 135 puts in there, all right, and then buying and defining the 125 puts. It's $10 wide, collecting $2.50. So I'm risking 25%, right, of that width, or I'm trying to get 25% of that width. I said that wrong, sorry. So if we look at the Analyze tab, you can see that if the underlying moves higher, we in fact get to keep that $250. If the underlying goes down, we do have defined risk. We have no more risk below 125. I could, in fact, just let everything expire and get long at 135 for Apple. I get to keep this credit. So despite the fact that the underlying might be moving lower or whatever, that credit is still mine to keep. So what I would be getting long at 135 in my portfolio, I also got to remember I've got $2.50 that I've collected. So my break even is much lower there yet. All right. So we want to take advantage of that. Go back to the, I was supposed to have a chart there. So go back to this chart. We're looking at this, and we were looking at the 135 strikes. So the 135s are below this support. So I'd sell the 135 puts, 135 puts, and then I'm buying the 125 puts. So that's where I'm risking. I'm collecting $2.50 credit, $250. So if we hold this support and we rally away, what have I done? I've used my technical analysis to help myself find that support and resistance and think that we're going to get a little bit of a bounce. I've also used high volatility to help me determine the right strategy, meaning I need to be selling an option strategy or the right way to trade the option. The volatility comes out, my prices go out. I don't have to be directionally right in that regard. And if I'm selling options, because I know the premiums are high, the next thing I know is that I got to get inside that 45 days to expiration, right? So that should be your thought process when you're going through and you want to trade options. First thing you do, come up with your directional assumption. If you don't have a directional assumption, well, then we have strategies for that too. Maybe the iron condor or something. And in this case, I've got a bullish directional assumption. That's the first thing I look at. I think Apple's a good directional move here. We're in an environment where it feels like you're catching a falling knife right now, and you might be. I might be. But at the end of the day, if I do catch this falling knife, being Apple at 135, I'll be happy to get stabbed there. I mean, we haven't been down there for 52 weeks, and that was basically coming out of the pandemic when everybody thought nobody would be on a phone or something. I don't know why that would happen, but it was supply chain issues. So that said, I'd love to buy Apple at these levels. We don't have the supply chain issues we had before, despite the fact that Singapore might be shutting down right now, that port. But with that said, I do think that Apple would be a good buy at this level. I'm not saying you go all in, you don't push all your cards in right now, but I would nickel and dime around here, put on a spread, hopefully be able to take advantage of volatility coming out or even getting long with this underlying. So I'm looking to sell the 135 puts. I've got a support here. So I've got one area to help me out. This next area, if I come down here, I'm just going to look to get long it, right? I'm going to let it press me a little bit on this one because I would be happy to let this strategy get put to me. Stick me Apple at 135. I'd be happy. And that's about it. If you guys don't have any more questions, I'm going to throw it back to you guys. I'll stick around for a minute, but here is our options lab. I'm going to throw this back out there. We had a bit of a snafu with some of it, so we lost some folks. It ended up kicking them out, but I don't know why. It just didn't accept them. We tried to get them back and didn't happen. So I figured I'd open it up to you folks. We have a couple limited spots. I want to get it back up to full just because I feel like you guys have an opportunity there. You can take advantage of giving me calls anytime. This says office hours, but my office hours are basically 12 hours a day, it seems like. So please reach out to us there. I'll throw the link in the chat window for you guys to be able to follow that one. But other than that, I want to thank you guys all. Again, this is not a link you guys can just click on right there. You're going to have to wait for me to get this over there in the chat. All right, I'll throw it out there. We're good to go. All right, there you go, folks. All right, like I said, thanks for bearing with me. I did jump in here a little bit earlier, but life is happening. I wanted to talk about this Apple trade because I know that a lot of folks are out there talking about Apple today. Big buyback. They actually did pretty good on their earnings. Are we still going? All right. Lost the screen. Take care now.